This is Shubhankar Chakraborty from American Academy of Financial Management. So we are taking these queries and we are moving along. And this is the fourth query that we have received. And the query is, how do time-weighted return and money-weighted return provide different perspective on investment performance? And the question is, can you discuss the advantage and disadvantage of each measure in evaluating the success of an investment strategy or portfolio? Fine. So let us first understand what is time-weighted return and what is money-weighted return. So what time-weighted return is, actually it calculates the compounded rate of return over a specific period. So it doesn't consider the cash flows that you might have in a strategy or an investment. It just gives you a point-to-point return. It only calculates a compounded rate of return from one point to another point. And it only focuses on the investment part. It doesn't focus on what has been the cash flow, when the cash flow has happened, so whether the investor has invested at the downtime or taken out the money at the downtime. It doesn't consider any of those. It just gives you a point-to-point return, right? And that is what time-weighted return is. Now, what are the advantages of that? So basically what it does, it eliminates the impact of cash flow. So impact of cash flow can have a can be very, very significant when it comes to investment performance. So agar aapne mano during the COVID time when the market was down, if anybody would have invested money at that point, their return would have been phenomenal. But that doesn't mean that that particular fund has generated, like, let's say, for example, that year, people who have invested around COVID time during March, April 2020, by the time it was 2021, April, their returns were showing almost double. But that doesn't mean that performance of that particular fund has been has doubled, right? So that's why time-weighted return will not say that. Time-weighted return will be a point-to-point return. So so your cash flow, the impact of cash flow will completely get eliminated there, and that is an advantage because if, let's say, it would have been the other way around, advantage kab hoga jab other way around hoga. Let's say you have invested in January 2020 and you have taken money out when the downtime started. You out of fear, you have taken the money out, and ultimately the return the final point when you compared it at January 2021, the point-to-point return was showing positive, but your return is negative. So from an investment advisor's point of view or from a fund manager's point of view, it's positive, right? Because it's an advantage. मेरा फंड तो रिटर्न दे दिया, आपका जो बिहेवियर था, आपका जो कैश फ्लो था, उसके चक्कर में you couldn't capitalize on that return, right? So so that is what TWR is. It considers the market condition, and like I said, it reflects the skill of a manager. So आपके कैश फ्लो के ऊपर उसका कोई असर नहीं पड़ता है. So that is the advantage of time-weighted return. However, it has a limitation. The limitation is it ignores the investor's behavior, which is what I told you. If you have taken the money out or if you have put in the money, so those things will get ignored, right? So agar investment fund ne 10-15% return diya and you couldn't capitalize more than 5% or 8% because of your behavior, so it doesn't give you the right picture of your investment return. So from an investor's perspective, it's a limitation, right? So that's why time-weighted return cannot be always giving you the right direction when you are looking at from an investor's perspective. It is giving you a misleading representation due to certain uneven cash flow which you might have done, right? So which is again linked to your investment behavior. Now that's where money-weighted return comes into picture. So what is that? It calculates the rate of return that takes into account the timing and the size of cash flow. So if you have invested this much at this particular time, it will consider that. So let's say, for example, if you would have not taken the money out at that point, or you would have invested, people who have invested, which I was mentioning, so unka return to kafi बढ़ गया था. So that's where money weighted return comes into picture. So from an investor's perspective, if you consider money weighted return, it is going to give you a better picture of your, it is going to give you a better picture of your investment strategy, and it will help you to analyze your investment in a better way, right? So it reflects the performance experienced by the investor. So it is not only linked to the investor, the fund manager, it is the investor's experience that it actually accounts for. Right. So what are the advantages? As an investor, like I said, it reflects your ultimate experience. So it is an advantageous thing for you. Your behavior gets considered. So if you have taken the money out during the downtime, for a fund manager's perspective, you cannot blame the fund manager, right? So because he will say that I have generated return, but it was your behavior. So from that perspective also, it's an advantage. Money weighted return gives them an advantage that it was your behavior that resulted in the downfall. Or from your perspective, you can say that, well, you have generated, let's say 15%, but it was my behavior that I invested at the right time. So my portfolio is looking at 25-30% return. So that way, it's an advantageous tool for investor as well. And it assesses whether the strategy is aligned with your objective as an investor. So ultimately, your objective is the final thing that we all invest for. So our objective as an investor, my objective comes at the prime, and that is an advantage of money weighted return. Through money weighted return, आपका जो investment strategy आपने अपना investment के लिए लगाया, that will get reflected through money weighted return. However, it has a limitation. Limitation क्या है कि ये investment का जो performance है, fund का जो performance है, उसको ये ignore कर जाता है. So it is linked with your cash flow. So आपने अगर सही वक्त पे सही इन्वेस्टमेंट किया तो ही आपका रिटर्न परफॉर्मेंस आता है. सो क्या होता है कि आपका इन्वेस्टमेंट, आपका फंड मैनेजर ने क्या स्किल दिखाया, वो यहाँ पे नहीं, मनी वेटेड रिटर्न के थ्रू आप यू कैन नॉट identify that, and that is why it is a limitation from an investor's perspective. तो उतना important नहीं है, but yes, it is a limitation because कोई investor अगर previous money weighted return देख के आ रहा है, it is difficult because it is a misleading way. क्योंकि अगर मानो किसी investor ने 6 साल पहले का money weighted return निकाला एक fund का, तो वो राइट पिक्चर नहीं रहेगा, बिकॉज जो इन्वेस्टर उस टाइम पे इन्वेस्ट किया था उसके साथ इसका बिहेवियर मैच नहीं हो सकता है, मैच ना हो, एंड ये इन्वेस्टमेंट मैनेजर का स्किल दर्शाता नहीं है. सो दैट इज अ मनी वेटेड रिटर्न कैन बी अ लिमिटेशन फॉर हिम, एंड सिंस इट इज सब्जेक्ट टू मार्केट टाइमिंग, so it is again a disadvantage, because if market timing has been good on a particular fund, then that fund might have done phenomenally well, but that cannot get replicated, right? So that is the other advantage, disadvantage of MWR. So that's why in such scenarios MWR will not give you the right picture and should not be used, right? So in a nutshell, time weighted return gives you investments performance, the performance of the strategy. Money weighted return gives you investors performance, how the strategy has been actually used or played by an investor. That is the difference between time weighted return and money weighted return. I hope you like this video. Thank you.